So you've watched your portfolio drop, plummet in just a few days, few weeks, where it's gone from here to, oh my gosh, what is going on? A really painful process to lose a ton of money. And people are sort of wondering like, well, wait a second, you have this huge loss. What am I supposed to do next? And in my last video, I said, look, suck it up, Buttercup. And I'm not here to step on people's toes or make them feel bad. That's not the intention of that. So I'm not saying this to hurt people. What I am saying is I'm trying to give it to you straight. I'm trying to tell you what I believe is the truth, and I'd rather be straight with you than beat around the bush. The straight answer is that this is part of the game. You're gonna get socked. You're gonna get punched in the face. The Mike Tyson quote, everyone has a plan until they get punched in the face. This was the punch in the face, or maybe one of a couple of punches in the face that's coming. So you need to understand what's going on and how are you supposed to deal with this? How are you supposed to deal with your portfolio, with your investments after you just got it right on the chin? So, a lot of folks think, oh, suck it up, Buttercup. That means hodl. Just hold on for dear life. The phrase I think that came from Bitcoin trading, hodl. That is actually not what I meant. And I'll get into the full context of what do I actually mean by suck it up, Buttercup. Like that means deal with it. But there's actually a lot more sort of layers to this. And that's why I want to make this video, is to go into what are you supposed to do when you have a huge loss. And I think it's really important, or when you've seen your portfolio take a real hit over a few weeks, a few days even, what are you supposed to do? And I come from the mindset of, look, it's better to approach these things with a Spock-like, cold logic versus the emotional, oh my God, the portfolio's down, I gotta liquidate my holdings, I don't know what I'm gonna do. Let's approach this with cold, hard logic, and let's do a quick plug before diving right into what do you do with a huge loss. And the quick 10-second plug is that my name is Daniel. If this is your first time tuning in, you're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. I'm very excited about our pipeline of upcoming videos, as I'm hoping to discuss Coinbase and what's that other healthcare company that we're looking at? It's Oscar Health. So another IPO. So I definitely want to cover those two. And the reason why is I'm looking for potential multi-baggers, types of companies that can go up hundreds or thousands of % over time. So if you're interested in learning about potential multi-baggers, make sure you subscribe. If you're already a subscriber, hit that thumbs up. And if you want to follow my personal journey to see what potential multi-baggers I'm buying, go to unrivaledinvesting.com, click on journey. Now let's go back to what do you do when you have a huge potential loss? What's sort of the game plan? So I said, first of all, it's not hodl. That's not it. It's not just hold on for dear life and that's the game plan. The game plan first is to understand what's the risk reward. You need to size up like, well, wait a second. Treat your holdings as if you hadn't bought them previously. Treat them as if you were going to underwrite that decision today. Would you underwrite the same decision today at the updated price? You need to think about what's the risk reward. What do I think is the upside? What do I think is the downside? And let me give a personal example. So my top two holdings are both down nearly at its recent lows. We're both down about 30%, nearly 30% from their highest uptick in the last few weeks. That is a huge loss for my top two holdings. It sucks. That is a painful process. Suck it up, Buttercup, to me as well. Like, you get sucked, you get punched in the face. You gotta understand this is part of the game. So you need to start sizing up. Well, wait a second. Like, what's actually going on? So first, I start sizing up the fundamentals. What's the risk reward? So, like, first, has their value proposition changed? As I look at these core companies, has something fundamentally changed with their value proposition? I look at both of them. They're both posting incredible figures, great growth figures. If they continue half their growth rates in the next 5 years, I'll be very satisfied with the returns. They both posted fantastic fourth quarter figures, and both their high growth suggests that they're unrivaled, that they're rapidly taking share. So, like, check. I don't really feel like I need to worry about that component. Let's move on to the next component. Okay, what's the risk reward based on taking what I think are reasonable assumptions on the underlying fundamentals, as well as a range of valuation. Let's say you use a really low conservative valuation on one side and a more reasonable or more market rate assumption on the high side. Not even crazy assumption, just reasonable range of assumptions. And like for my number one position, I'm looking at downside of like down 20% and upside of 200%. I'm like, okay, I like that risk reward. I like the game I'm playing. You do look at my next largest position. It's like pretty much break even and maybe a little less than 200%. Like ballpark, same sort of figures. And that's what you want, in my opinion, for when you're thinking about risk reward, is like, hey, is my downside covered? Like I'm probably not going to lose that much. And my upside, I can make a ton. Now, of course, like, could it go way higher or way lower? Absolutely. And honestly, if things get worse and this just turns into this isn't a small storm, it turns into like a hurricane and you're just getting completely beat up, like, I would expect to see these, my positions where my low side is like up 50% because the price gets hammered so low. And so that's something I'm always factoring in, is like, okay, this is where it is now. Could it get better? And that's something we'll talk about in a second. And of course, I could be wrong about my assumptions. Maybe my assumptions, maybe the company doesn't deliver the way I expect, or maybe, I misjudged their prospects, or I misjudged management, or the range of valuation assumptions isn't appropriate because interest rates does something, or who knows what. But this is, once again, this is not HODL. This is size up the investment today based on its risk reward, based on its valuation, based on its fundamentals. What is driving the stock? So if you're just buying something because it was a high flyer last year, and you're not saying, what are you going to do for me next year? Not just based on locking in this idea, oh yeah, price momentum is going to drive it higher. Folks, wake up. Price momentum just broke for a lot of things. So you want to wake up and say, okay, what are the fundamentals that's going to drive this higher in the year ahead? What's the valuation? So every time I buy something, every time I look at all my positions, I want to ask myself, what happens if it drops 50%? And just look what happened over the last few weeks. My top two holdings dropped nearly 30%. That's so you should be asking yourself, like, what if it drops a huge amount? Now, of course, no one wants to think about that. Everyone wants to think about, what happens if it goes up 500%? What am I going to do? How much more awesome will I be if my portfolio is up even more? That's the wrong way to think about it. You're daydreaming. You need to focus on, like, what happens if this goes poorly? What happens if I get punched in the face? And so having this sort of mental model, I think, prepares you for tough weeks, tough volatile weeks, like we've seen the last few weeks, like we've seen arguably last month. And this gives you the flexibility to do what you should do, in my opinion, during this time of stress, during these stressors, because you're saying, oh, I've already walked through this mental exercise of what happens if this falls 50% just based on price, without fundamentals getting hit, without, let's say, the thesis being busted. You're just saying, well, wait a second, what if purely on valuation it drops 50%? Not fundamentals. Let's say they keep posting reasonable results. Purely drops on valuation. What do you do in that scenario? And I think it gives you the mental flexibility to say, hey, if it were to that happen, I would want to buy more. So I'd want to make sure my portfolio has cash available, or I'm in a position where I could capitalize on it, versus being a seller, being a forced seller. We'll get into forced selling in just a minute. You never, ever want to be a forced seller. So you have a position, you think it could drop 50% over time. Maybe that means you leg in over time. Maybe that means you don't buy everything up front. You say, hey, this is a company I like. Maybe I buy a little bit now that it's sold off. We'll see how much it sells off. Maybe I buy a little bit more. We'll see. That's why I propose tracking things over time, seeing how companies execute, and based on how management is delivering for you, the shareholders, that's how you determine if you want to partner with them even more. It's not just little pieces of paper or little Robinhood, hooray, you traded this. No, that's not it. You are partnering with a company when you're buying shares. They have to earn that right. So you need to ask yourself, are they executing? And this is a long-term dance. And it's amazing that these are public companies, and you can make that decision slowly but surely over time. If they're a private company, you don't have that right. It's buy now or not, and that's it. And hopefully they do another, maybe they do another raise in the future, in which case you have another bite at the apple at a different valuation. Here it is, every day you get to watch them execute. Oh, what are the press releases around their operations? What are their quarterly results? Are they delivering? Are they still unrivaled? So leg in over time, but also if you go all in up front and you're like, hey, I'm going to borrow money to do this. Now you're putting yourself in a position to be a forced seller. And you never, ever, ever want to be a forced seller. Because if you're a forced seller or you have margin debt and you get taken out of the game because prices are volatile, you're done. You're out of the game. The whole point of this game is you need to stay in it for as long as possible, compound your money at a good rate. That's the goal. If you get taken out of the game because prices were volatile, that's it. So focus on what you can do. If you have margin on it in a big way, I'd want to rethink about my volatility and what volatility could mean. Because if you have margin on in a big way, it's possible you are 100% right about the company, but just because it wiggled a little too much, you get taken out. And that's no way to play the game long term, especially if you're right potentially. So a couple of these concepts I think have been expressed in this book, this wonderful book, The Psychology of Money by Morgan Housel. And one of these concepts that I think I've talked about and he talks about, which is that the reason why stocks are so attractive long term is because it's super volatile, and ultimately the periods you're going through from time to time, that's the price of admission. You want to go see a movie, you pay a ticket. You want to have a nice experience, you pay for that. You go to a restaurant, you're paying your bills there. It's the same thing with the stock market, and that's the same this is the idea that I'm paraphrasing from Morgan Housel's wonderful book here, which is that in the stock market, the reason why generally stocks deliver better returns than a lot of other things is because you have the long-term nature, long-term compounding of these companies, their earnings growth growing over time with the economy. But the cost of admission to getting that return is the volatility you have to stomach, is sucking it up. And that's why whenever you have a loss like this, you need to understand, okay, this is the price of admission to the game I'm playing. So I hope this video has been helpful for you in terms of thinking about how to deal with huge losses. To repeat, first of all, it's not hodl. Second, it's understand what your risk reward is and try to have a reasonable range of assumptions, and to show a reasonable approach. Like if you're just doing this on price momentum and the price momentum broke recently, you might want to rethink your thesis. If you should prepare every time you buy something, and also have a plan for how you buy something. Do you just buy it all up front? Do you use margin to buy it? I wouldn't suggest that. I would say, hey, pace it out over time, leg in over time. You don't know if something's going to drop 50%. Would you feel comfortable making something, let's say 10% of your portfolio, if it drops 50%? Would you feel comfortable buying more if you started it and made it 10% of your portfolio now? So that's why it's critical to ask yourself, what happens if this drops a lot more? You never want to be a forced seller. You never want to be in a position, and that might have to do with portfolio allocation, that can do with margin debt, that can deal with time frames. For example, if you're investing and say, hey, I need this money 6 months from now, you can get taken out of the game 6 months from now as you expect, but get at really lousy prices. So that's why it's so important, in my opinion, to have a long-term time frame. And that's why in all my companies I look at, I'm always looking at this over a multi-year, 5-year minimum horizon when I'm looking at companies. And in each video I cover a low, a high range for how I think about these things, doing what I consider is a wide range of earnings multiples and scenarios in terms of their results. And lastly, as discussed in Morgan Housel's wonderful book, this process, getting punched in the face with the stock market, that is effectively the price of admission. So if you got to play the game, you got to understand the price of admission. If you enjoyed this video, learning about what do you think about when you're facing a huge loss, make a point of subscribing. If you're already a subscriber, I appreciate that thumbs up. For some of the the positions I were talking about earlier, my top 2 largest positions, you can find out about that by going to unrivaledinvesting.com. Click on Journey. Thank you so much for watching.